Watching TV recently, I couldn't believe the number of times a reverse mortgage ad came up. I see these ads like regularly now on TV, and they look so easy. And I thought, is this the way to unlock the equity in my home? Or for other retirees. The ad made it seem that most retirees think a reverse mortgage, solves their cash flow problems or the retirement needs. Well, and I was wondering, how does it differ from a home equity line of credit or HELOC? So in this video, I'm going to walk you through what a reverse mortgage actually is in Canada, how it compares to a HELOC or a home equity line of credit. Both are loans, and how do they work? I'll tell you where most people go wrong, and one strategic way a reverse mortgage can help that almost no one actually talks about. So let's start with reverse mortgages, because this is where a lot of people move forward without really fully understanding the cost. And many retirees today are sitting on hundreds of thousands, sometimes over $1 million in home equity. And for those who want to stay in their home but need access to that money, the question really becomes for them, how do I actually unlock all of that money? So they may not want to draw down their savings, and in many cases, they can't qualify for traditional lending like a HELOC because they don't have the kind of income major Canadian banks require. So even though they're asset rich, they feel stuck when it comes to accessing their own equity. So this decision doesn't usually start with someone wanting a reverse mortgage. It really starts because they're trying to figure out how to access their equity without disrupting the retirement they've worked so hard to build. In fact, I know someone who had a couple $100,000 sitting in a bank after selling an investment property and still couldn't qualify for a HELOC because they didn't meet the income requirements that the bank needed. So let me show you something quickly. If someone borrows in a reverse mortgage $400,000 at around 6 to 9%, and that's a typical interest rate now, and makes no payment, that loan can grow to roughly $750,000 to $946,000 in about 10 years. That's a lot of money. And over 20 years, it can approach or even exceed $1.4 million. That's the power of compounding within a reverse mortgage. Unlike a traditional mortgage or a HELOC, where the principal loan amount decreases over time because you're paying down the loan, with a reverse mortgage, your amount owing is growing each and every year you have one. So the loan amount is growing, not decreasing. And people don't think about that, and it certainly isn't shown in all those commercials with Kurt Browning, that's for sure. So, and in this part, most people don't fully grasp when they first look at this option. So let's look at what a reverse mortgage actually is. So in Canada, only Home Equity Bank or Equitable Bank offer reverse mortgages. They're aiming them at retirees primarily as a way to unlock that person's home equity. You can access roughly 15% to 55% of your home's appraised value, and that depends on your age and length of time you want the mortgage. Remember, the lender wants to make sure the home's value remains higher than the reverse mortgage amount when it comes time to pay back that mortgage. So that's why those two things are important. And the amount loaned depends on the expected length of the mortgage and your age. You can borrow more at 80 years old than when you're 55 years old. And the higher the appraised value of your home, the more mortgage that's available for you to access. Now, cities in Southwest Ontario would obviously have higher values than other parts of Ontario. And reverse mortgages are offered in British Columbia, Alberta, Ontario, and Quebec. And in most cities, rural areas may not qualify, so there's something to consider if you live in a smaller town area. There can't be a mortgage on the property, although you can pay it off from the reverse mortgage. Basically, what you're doing is you're swapping a conventional mortgage with a reverse mortgage. Now, this wouldn't be the best thing to do, in my opinion, but in the right circumstances, it might actually make sense. And to be eligible for a reverse mortgage requires actually 3 things: being a Canadian citizen, at least 55 years old minimum, owning a home, and a location of the home that these two banks service. So, and I'll get a bit more on that later. So you can take the money either in a lump sum or monthly payouts. There is some strategy to think about with this. A lump sum means the interest is on the entire amount versus taking a monthly payment means the interest is based on the smaller amount. And the second way means less interest paid because each month the amount owed would be less than the lump sum amount that interest is building on. So just like a regular mortgage, there are open and closed terms, and the terms are fixed like a regular mortgage, so 2-year, 5-year, 5-year, and an open mortgage. Interest rates differ based on the time frame. Shorter time frame, higher rate, longer time frame, lower rate. And be aware that open has a higher interest rate, just like a regular traditional mortgage. And repayment happens upon death or selling the home. Now, interest calculation. This is really key. The loan is compounded semi-annually for fixed term and monthly for variable mortgage. So interest is calculated on the amount you borrow, not qualify for. And like I mentioned, if you choose a lump sum, you are accumulating interest on that entire sum versus withdrawing a monthly sum. So what's the compounding? Well, interest is calculated and then added to the total amount owing. So next time interest is calculated, it's on the total amount owing, which includes interest from the prior period. So think long-term results here when you're thinking of a reverse mortgage. And both fixed and variable rate reverse mortgages calculate and charge interest on a daily basis. Now, you don't need income to qualify like a traditional mortgage or a HELOC when you bought your house, and there are no mandatory monthly payments. Again, the opposite to what happens with a HELOC, because you have to pay a monthly payment with a HELOC. Instead, the interest is added to the balance over time, as I mentioned earlier, and the loan is repaid when the home is sold or when the last homeowner passes away. So that's why the interest rate is higher, because the lender is taking the risk up front and has you pay for that risk. You still own your home, of course, and you're still responsible for property taxes, insurance, and maintenance, whether you have a reverse mortgage or a HELOC. Now, let's compare that to a HELOC or home equity line of credit. So a HELOC can allow you to access more money, sometimes up to 65% of your home's value, but the qualification is based on income and credit. And as I mentioned already, this may be difficult for retirees who don't have traditional income. And you must make monthly payments with your HELOC. And HELOCs are available on all homes, all provinces. Reverse mortgages, like I mentioned, are only available in certain provinces right now. So that difference matters, especially in retirement, because qualifying for a HELOC can become harder once income shifts to pensions or investments, while reverse mortgage removes that barrier entirely. And this is where most people get confused. Reverse mortgages feel easier because there are no payments, but that convenience comes at a cost. Interest rates are typically higher than traditional mortgages or HELOCs, and often by a minimum of at least a couple of percentage points. And because no payments are required, the interest compounds over time. And that means your equity gradually decreases the longer the loan is in place. Now, in Canada, there is a safeguard. You cannot owe more than the value of your home when it's sold, as long as the loan conditions are met. So here in Canada, it's called a non-recourse loan. But that doesn't mean the cost disappears. It simply caps the downside for the homeowner. And there are also additional factors people don't always consider. There are setup costs, potential legal requirements like independent legal advice, and a lien is placed on the property. But that's true of a home equity line of credit as well. And you also must keep up the property taxes, insurance, and maintenance, as I mentioned, or the loan can be affected. And if this hasn't been clearly discussed with family, it can create tension later, especially if there are expectations around inheritance. So this tends to affect retirees in a few specific situations. People who are asset rich but income limited, people who can't qualify for a HELOC, people trying to stay in their home while covering rising costs like healthcare or want to supplement their in-home support, and people who have a home that needs work but don't want to draw from their investments to pay for those updates or repairs in their home. So how do you think about whether this makes sense for yourself? Well, you need to weigh three things. One, the cost of the interest. Two, the length of time you plan to use it. And three, the reason you need the money. If this is a long-term solution, let's say 10, 15, even 20 years, the cost becomes quite significant because of that compounding that's happening. You know, you're compounding interest on interest. If it's a short term and it's strategic, it's a very different conversation. There is also flexibility that many people don't realize with a reverse mortgage. You can choose to make voluntary interest payments on your reverse mortgage, which can help reduce how quickly the balance grows. But the bigger question is always whether this is the best option compared to alternatives like downsizing. Maybe you can refinance or restructuring your assets. This should never be the first option explored. It should be one of several considered. So now here's the part almost no one talks about that is really quite an elegant solution at times. Using a reverse mortgage short term to prepare your home for sale. So someone is ready to move, but the home needs updates before going on the market. Maybe its flooring is all worn, you know, there's carpeting that needs to be replaced, or the paint is all dated, the lighting has to be updated and hasn't been in years, or the furnace is older, roof needs replacing. Doing these types of things make a really big difference. It can mean selling in less time and for considerably more money. And today's buyers notice all of it. There's lots of choice for buyers today, and they are becoming more and more picky about what they want. But the homeowner doesn't want to pull from their investments or disrupt their retirement income to pay for those updates. So instead, they can access a portion of their equity via reverse mortgage. They make the targeted improvements, and what I mean is not over improving, just enough to really elevate how the home shows. And then they sell. The reverse mortgage is repaid from the sale proceeds. So what this can do is protect cash flow while improving the outcomes of the sale. And buyers are buying a mortgage payment. Remember that. They're buying that mortgage payment. Down payments are so high, buyers don't have the extra 10 or 20,000 to do the updates, but they do have the ability to pay an extra $200 or $300 a month in mortgage payments for a higher value home. And that often means a faster sale for this homeowner, a stronger offer, and in many cases, a higher price. And that is completely different use than holding reverse mortgage for decades. At the end of the day, a reverse mortgage is not a miracle solution, and it's not automatically a mistake. It's really a tool, strategic tool to be used. Used without a plan, it can slowly erode one of your biggest assets' value. And used strategically, I think it can really create flexibility for you, control, and sometimes a better financial outcome for you. So the key really is understanding how it works before you ever need it, and making sure any decision you make fits in with your overall plan, just not an immediate situation. Because this isn't just about accessing money, it's about how you move into your next chapter.